If you have benefited from taxes as a result of syndication, and then that syndication goes through foreclosure, you're essentially going to owe a nice little bill to taxing authorities. I started the business on Twitter. I get off the phone at least a few times a week with people that lost, let's say, 20% of their net worth in one deal. I think the same traits that can help someone amass massive wealth can actually make you lose a ton of wealth. I decided to just try to cold call owners in Phoenix and see if I can buy a property.
This is Axiom Alpha, where we talk about building and investing in businesses with unfair competitive advantages. Welcome back, everybody. I'm Ricky, and I'm here with a sort of micro celebrity from real estate Twitter. Actually, that sounds like a bit of a left-handed compliment, but I meant it genuinely. This is a guy who worked his way up to become the portfolio manager at a $10 billion REIT, and then left all of that to become an entrepreneur, and now he is a consultant for real estate investors. Alexi, how long has it been since you launched your consulting business?
Hasn't been 5 months. Getting close to it though.
It's a bit of a difference from the REIT world, I imagine. What's been the biggest culture shock of changing?
I think it's extremely similar and different at the same time. It's similar because what I did at the REIT is I ran the underwriting team and the portfolio management team, and so I think more than anything, my job was always to figure out whether the risk reward on a particular deal made sense. And I ran a 20-person team, so on any given week you'd see dozens of deals, and as with any process, you sort of try to weed out the bad ones early so that you spend more time on the better ones. There's sort of like a funnel. And I think there's some similarities here. I think the difference is that before I was generally dealing with, both on the customer side and on my team side, people that have a certain amount of investments knowledge. Whereas now, most of my time is spent with people that have built tremendous wealth outside of real estate and outside of investing, which I think is very special. But as I've slowly learned, I think the same traits that can help someone amass massive wealth, that same sort of risk-taking mentality can actually make you lose a ton of wealth if you don't think about it properly from an investments perspective. Because when you're building something on your own, you typically know a lot about it and you're in control, right? And then you take that wealth and you still want to take on the risk, but the difference now is you're not in control of the destiny, and you also know less.
Yeah, also real estate doesn't have the same upside as, building an operating company. You have to control the risk more because you just can't take that much risk and still have a risk to reward ratio that's attractive.
Exactly.
You can build a company that just, 1,000x's in value. You're not really going to get any real estate investment that 1,000x's in value. So fundamentally, you just have to choose something that is less risky.
Right. And I like to refer to that. I just sort of made this up myself. It's sort of probabilistic upside, if that makes sense. In other words, any real estate equity transaction, hypothetically, I mean, it can have 1,000x. It's just that very, very, very rarely happens to close to none. And so just like no one should invest, in my opinion at least, invest in a stock market index and expect it to return 30% a year, everyone would call you crazy for that. So similarly, no one should invest in real estate expecting 30% a year or 20% a year or whatever it is. And so in that sense, and it's really in a probabilistic sense, because any given deal can do whatever it ends up doing. But in a probabilistic sense, the upside is capped. And to your point, since the upside is capped, you better make sure that the downside is capped. And that's not to say that it's risk-free, right? I hear that a lot. Real estate is definitely not risk-free. It's an investment. And a lot of the due diligence process, in my opinion at least, should be spent on making sure that you understand that downside. What can happen to impact you in a negative way.
Yeah, I know you have sort of been blowing up on Twitter, or at least on my Twitter. I think it's Twitter in general, for the, there's been a lot of syndicators that have been having problems losing tens or hundreds of millions of dollars. Investors get into hot water. And so I think, your expertise has come to the forefront of the Twitter world. So I want to get into that. But before that, I want to dive a little bit into your business model to start with. So you advertise yourself as an LP advisor, but I think you actually advise or consult with multiple groups. Based on your emails, I think you do GP consulting and LP consulting. So on the passive investor side, the LP, and for the fund manager, the GP. And so I think you have a couple different revenue streams. You basically you advise passive investors or LPs who are considering investing into a syndicate or investment fund, or who are stuck in an existing fund that isn't performing very well. You
Yep.
advise GPs on how to improve their pitches to LPs, how to communicate with LPs, especially when things aren't going well, and how to help, and you help GPs actually review their proposed real estate deals. I think you have a course also teaching LPs how to analyze passive investment opportunities. And
Yeah.
then you have a paid newsletter for LPs. Is that right? Did I miss anything or mess anything up?
Yeah, no, no, that's exactly right. And the way that the entire business started is I figured if someone is looking at a deal, they would pay $1,000 to get it reviewed just to make sure that they're not missing something. It's something that I would probably pay for myself, especially if I'm investing, let's say, 50 to 100 grand or more. People, this is maybe a side tangent, but people don't often think about the fees that they're paying. And as a result of the fees that they're paying, you're sort of down on your investment day one. So I think if you're going to be down on your investment day one, you better be sure that it has a high probability of success. But even if it's not 2x or whatever, I mean, it just you got to make sure that you're not going to lose your money and you're not making a big mistake. And yeah, and to your point, like that has evolved into a bunch of different things. Like I would say my core time and effort is spent on educating LPs, and that has sort of evolved into a few different streams of business, including LPs that have capital calls or decisions to be made on existing holdings, and then a lot of GPs have reached out as well. In fact, that's probably, I mean, it's certainly at least 50% of my inbounds is from GPs, mostly asking for me to help them raise money, but I just say no to that because I don't know. I feel like that's a conflict of interest.
Yeah.
But if a GP sends me a deck, like I have no issue telling them how I would review the same deck if it came from an LP. And I think to a GP that's, at least so far, it's been super helpful because LPs, they tend to shy away from like giving GPs like real feedback. They'll just say, yeah, like I don't know, I'm not liquid now, or I'll maybe I'll do the next one. So you don't actually get great feedback on why people are passing. And so I try to be that independent source.
Yeah, I was kind of curious about that, what the breakdown would be, because it definitely seems like a lot of, I'll say, media that is aimed at LPs tends to attract a lot of GPs, perhaps even more than the LPs.
Yeah.
And so I don't know if you know if you're familiar with the Opportunity Zone podcast.
No, but I can understand what it would be about. Yeah.
Yeah, exactly. So the Opportunity Zone podcast, the guy, the host, is always talking about this is for LPs. We have an audience of LPs, but the people who I know who listen to that podcast are GPs, and also the people who are, the vast majority of guests on are obviously GPs, and it's just kind of funny that I feel like it's almost like if you wanted to start a GP business, you should just advertise yourself for LPs, and then all the GPs will come.
Yeah. Yeah, and I think I very intentionally target LPs from a business. The biggest reason, to be honest, is a lot of them are really clueless. Like, and I feel for it. Like, I get off the phone. I mean, sometimes once a day, but usually at least a few times a week, with people that like lost, let's say, 20% of their net worth in one deal. And of course, like in hindsight, it's like, why would you ever do that? But the reality is that people do, and they didn't have sort of like the guidance to have someone to push back on it or ask questions. And it just sucks. It just sucks to see it. And like I'm hoping that with enough time, LPs will get more educated. And I think if you think about the business at a macro level, really my goal is to sort of funnel LP cash to better risk adjusted returns, right? In other words, I want LP capital to go towards better opportunities, and any GP that is out of market in terms of like what they're offering from a risk adjusted perspective, I think they should probably adjust to what market is for whatever experience level that they have, whatever risk it is, etc.
Can you take us through an example of what happens in a deal that you're contacted on? So, LP calls you up, says, hey, I'm getting a capital call. Are you primarily, a therapist coaching them on, hey, you lost your money, that really sucks, like here's what you should look for next time? Or is there anything you can do for the LP at that point?
Yeah, so it's funny that you say therapist because I've realized that there's definitely like a psychological component to this. Typically, to your point, on a capital call situation, someone will reach out, tell me how much they know, and you'd be surprised. Many times it's not much. In other words, they say, "Hey, I invested 500K into this particular deal. Like, here is the email that I got," and they'll forward it to me. The emails from the GPs, I would say 2/3 of the time, are extremely unhealthy. In other words, like they don't provide you enough information. There's sort of like this pressure to invest without information. And if you don't invest, you're going to get penalized. And so before I go into the analysis, the first question I always ask is, do you have the cash? And sometimes I'll get what do you mean? And I'm like, I just say, like, do you have the cash? And the reason why I ask it is sometimes people are borrowing to fund the capital call, which is, it's not right or wrong. It just totally changes the picture. People will borrow from like their 401k, from like a mom at some point I heard, and it's like, I'm not, that's like a whole different aspect of the decision that I just want them to be aware of. So now if you do have the cash, then we treat it as an investment decision, which I think it should be. In other words, if someone came to you today and said, "Hey, I know you're not involved in this deal. You don't even know who I am. Do you want to invest in this deal? Here's the structure. Like, here's the capital call structure. Here's your returns, etc., etc. Would you do it?" And I would say 7 out of 10 times it doesn't pass because there's just not enough information in the email. And at that point, we sort of compile a list of questions to send to the GP to understand where the current position is held, just in terms of valuation, and what returns they could expect on the new money, because that new money can be invested into something else, a new syndication, a new venture capital idea, your own business idea, stock market, whatever. So it's pretty complex. And unfortunately, Ricky, as you've pointed out, many times the conversation starts there and it ends with the realization that their 500K is gone. That's not always the case. In other words, there's plenty of capital calls where the equity is still healthy and in a good place, but I would say the majority have impaired equity of some degree. And then you also have to have discussions about taxes. Like, I'm not a tax professional, not a CPA, but there's just basic things to know. It sounds like you've written some tax stuff in the past. Like, if you have benefited from taxes as a result of syndication, and then that syndication goes through foreclosure, you're essentially going to owe a nice little bill to taxing authorities because you benefited from that before, and now the money is gone, but the IRS needs to get paid back. So there's like the first surprise of like, what is a capital call? And it's like, oh crap, this is not good news. And then the second part is, oh, what do you mean part of my investment is gone? Isn't it just an asset and I can just sell it? And then the third aspect is, in many cases, there's a pretty large risk of foreclosure. And if they have benefited from taxes, then that sort of is like a third degree challenge. They're not easy conversations.
Yeah. In one of your articles, you talked about vetting LP investments on the basis of three pillars: the like GP's ability to execute, alignment of interests between the GP and LPs, and the investment property itself. And I think most people intuitively know that looking at someone's ability to execute is important, and they know that the property itself is important. And the alignment of interest, I feel like, is the weak link that people overlook most commonly. Would you agree that that's probably the biggest thing that gets people into trouble to start with?
Yeah, absolutely. In fact, I think the three that you've pointed out are sorted in that way for a reason. Like the first is execution, which to your point is like track record, the ability to just trust this person, experience, who's going to make decisions, etc. The second one, to your point, is alignment of interest. And the third one, which usually surprises people, is like the underlying property. And I think in many cases, if you focus enough on 1 and 2, you might not even get to 3. Like you might not even get to looking at the property. And I think from what I've seen, at least, people tend to reverse all of that. Like they immediately look at the property first. Many of them will look at like fees and waterfall structures, which is, in my opinion, kind of like the alignment of interest bucket. And then, they'll sometimes they'll just entirely skip the execution part. It's just like, oh, like track record, I don't know, like they've done a few deals, like my friend invested in them and it was okay, so like seems fine. So to address your question directly, I think the reason why that is because alignment of interests, they matter on the upswing, when things are good, but they matter a lot more when things go south. And the fortunate or unfortunate reality is the past 2 years have been pretty good. Like the overall macroeconomic interest rate environment was pretty phenomenal for real estate for a long time. And that was changed, right, in 2022 when things started moving up. And so now LPs are painfully waking up to the realization that the GP is not really aligned with them in distress situations. And I can go into examples if you like, but it just, when things go south, the interests of a GP and an LP can go very different ways. And that has a pretty big implication on your returns as an LP.
I'd love to hear an example.
Yeah. I mean, I just shared one today actually on my weekly digest. So I just saw someone tweet about this. It's like, a GP. It was like a text conversation. And this guy from Twitter basically asked the GP, like, hey, how's it going? And he essentially said, like, not great. And this is like almost verbatim. It was something like this. It was like, we've tried to sell the property, but we can't get to our projected numbers. But the interest rate cap isn't expiring for another year. So on the face of it, when you read that, it's like, oh, okay, like makes sense. You tried to sell, you're not getting what you expected. So let's just wait it out and like see what happens, right? Like, why not? The problem with that statement is for a GP and an LP, that decision might be very different. So said another way, when you're sitting there today and you're making decision whether to sell or not, that should be like a risk-reward based decision, right? And just because you realize that you can't make the 2x that you originally promised them doesn't mean that today isn't the right time to sell, right? In other words, the GP is sitting there and thinking, well, I'm going to have some unhappy investors because I didn't realize the 2x, so why don't I just wait and hope that it gets better? The LP is just going to be sitting in that seat. And of course, many of them don't get this information. They just, don't hear an update and assume that they're operating it. But from the LP perspective, it's like, well, we can realize a 1.5 times today or take on additional risk and potentially realize a lot less. So they would actually prefer to sell sooner rather than take on that additional risk. And what tends to happen in these situations, particularly in situations of distress, is a GP, they are monetarily incentivized by their promote in any given deal. And when that promote is going down or evaporates, the money is elsewhere. Like they might be running 10 different deals and your deal is not worth anything to them. So their mind, maybe on purpose, maybe not on purpose, but they start switching their mind to like the other deal or a new deal, right? Like might as well transact on something new. And over there's going to be a promote. Like, why am I going to spend time on the current thing where like I already know like the best thing is I get my LP's monies back, but like I don't get anything, right? So that's what I'm talking about. Like on the downside, you start seeing this divergence that is really important to think about up front.
Yeah, even on the upside, I mean, you're incentivized to take more risk with that promote. You tweeted this structure that was, you said like the best alignment that you'd seen between an LP and a GP, and I think it was something like a 15% preferred return, so complete return of LP capital, and a 15% preferred return to LPs, and then GP got 100% over that, which is great. But even that, I mean, in real estate, you're a little bit more constrained in the risk that you can take, but you can still take plenty of risk. And so it's like, well, if I have to get to over 15% to get a return, then I'm incentivized as a GP to take a whole lot more risk because otherwise I don't get anything for my time.
Exactly, exactly. And so I commented a little bit on that thread, I think, in that the reality is that there's no perfect structure. I certainly thought that structure was very favorable. Now, the con to that, as you pointed out, is like, what if people just go bonkers and just go acquiring anything to hope that they make 15% and then anything above they'll make. So from an LP perspective, I should know that, and I should treat the diligence process knowing that this should be a high risk transaction. Otherwise, they're not going to be in the money, right? I think it's important for an LP to understand, given a structure. What's the phrase? I can't remember where this comes from, but it's like, show me someone's incentives, and I'll show you how they'll act.
It's like a Charlie Mungerism.
Yeah, yeah, maybe that's where it comes from. But actually, I think that might be right. So that's really important, to really like dig in and figure out like, when is your counterparty going to be paid, and what incentivizes them on the upswing and the downswing.
If you were going to advise a GP on how to create the perfect structure, if I'm a GP, trying to be as aligned as possible, what structure do I use in terms of fees and performance?
I I actually think it really depends on the goals of the GP and the type of LPs that you're going after. If you're just telling me like, here's an average person, what should they do? I would just recommend a typical pref with a split. I just think it's standard, it's more understood, and I think there's something to be said about a pretty solid alignment of interests in both directions, right? As long as there's a solid co-invest that goes along with it. But the 15%, as long as the LP does a lot of diligence on the front end, it's very LP friendly. Like I would argue overly LP friendly, right? Because the return of capital plus 15% is the first thing in the waterfall. Whereas with a typical 8%, 80/20, 70/30 structure, the promote starts kicking in much sooner. That incentivizes the GP to potentially sell earlier, or at the right time. And that also like that sort of balances things out a little bit more.
Yeah, I've found this fascinating to look at, waterfall structures and fee structures of funds. So it's kind of something I nerd out over. I don't think I've seen this in a real estate fund, but in hedge funds, I am intrigued by the structure that sort of treats the equity like leverage. And so you take upside and downside. I take like a 10-to-1 leverage basically. And so it's like, if we go up 10%, I get 10% of that. If we go down 10%, I take 10% of that downside as well. So you put in some initial capital and then basically treat it like leverage. That seems pretty aligned. And I mean, I like that structure. I don't know if it works as well in real estate, but for hedge funds, I like that structure. Have you ever seen that for a real estate deal?
Just maybe define it a little bit more for me. So let's say you started with $100. I like to make things simpler. So you started with $100. You're the GP, so you contributed 10 of it. That's what you're saying, right? Like that's the initial co-invest.
Yeah, so it's basically like I get a split on the upside and the downside.
Uh-huh.
So, if we, let's say I get 20% of the upside, 20% of the downside.
Right.
Have you seen a fund that uses that in real estate?
I haven't. Now, I think there's a co-invest component too. You know what I'm saying? In other words, one is that. Two, there's not like really a mark to market accounting that helps with, which is pretty helpful on the equity side, especially in public markets. I think it would be a decent thing to explore.
It basically, like in the case that you were talking about where, oh, I lose interest because I don't have my promote anymore, I'm just going to put my mind share elsewhere because this deal is not going to reach a metrics. This structure, I think, would keep you incentivized because it's like, well, I'm not going to make anything, but I'm going to take 20% on whatever is lost. So, if we sell at 80% of the value instead of 100% of the value, we lost 20% of the equity. I take 20% of that 20, so I lose 4%.
How does that mechanically work? How does that mechanically work? In other words, if you didn't contribute, like for example, if you didn't contribute any money.
You would have to contribute money. You have to contribute. It's basically like you're treating it like a margin account.
Okay, so then what you're saying is like a 20% loss would mean that you would lose 20% of your invested equity.
Potentially, you would lose whatever you lost plus 20% of whatever the LPs lost. So, like, if you put down $100 as a GP and the investment went down 20%, you would lose $20 plus out of your 80, 20% of whatever the LPs lost. So instead of just taking the 20% of the upside on whatever the LPs make, you also pay 20% of the downside on whatever they lose.
Right. So I mean, my initial reaction is I think there's sort of like three steps of a promote in some sense. Like there's a case where they're in the money, the promote is in the money. Then below that is the promote is out of the money, but the equity is still there, right? So that's the case where I think this would be helpful, right? That's the case that you're describing where the promote is out, but the equity is still in the money, so they would be incentivized to sort of act in a way to not lose more of their money in proportion to whatever losses occur, as you've pointed out. Now, what I'm seeing a lot now is the third one, which is like the equity is gone. Like if you go sell the property, none of the equity will be returned to the GP or the LP, right? And there, I mean, unless you sort of force the GP to make a payment, which like I mean, most GPs just don't have the money at that point to pay it. Not all, but most. It's tough to rescue sort of something like that because at that point the LPs are just going nuts because they're like just do anything like save 20% of my money, 25, anything, 10. And the GP is like not only am my promote is gone, my equity is gone. If they put any equity, many times they don't, even though I think they should. But at that point, it becomes like really slippery because I mean, they almost like, I mean, the only thing tying them to that deal is ethics, basically, and like PR,
Yeah.
which is a whole other. That's a whole other podcast for like an hour because
The PR is positive and negative, though, because like you said before, it's like, well, I can take the risk. I can hope that things will get better, and then maybe PR will never be an issue. Versus if I, return capital now, then maybe I avoid more loss, but I also take somewhat of a loss, and my PR still suffers. So
right. So like I mean I know of some of these cases, right? I'm not going to mention names because I never do, but
why don't you ever mention names?
I just I don't know if it's for I mean legal reasons number one, but two I just I don't know if defamation it will help, you know. I don't know. I've thought a lot about it. I might at some point, but I think I'm not legally prepared to do it yet.
That's fair. That makes sense.
Typically GPs have more money in the bank account than I do, and even beyond that, like I just don't know if I want to have those conversations. Even though I think it might save some LPs from making mistakes, but anyways.
That's what I was thinking. I know you on Twitter. People ask you all the time. They're like, "Oh, who are you talking about?" You're like, I'm not gonna say." So yeah, it makes sense. Definitely defamation suits are not fun.
So just going back to that example, like I know of several funds today. And when I say funds, I don't mean like necessarily they're running a fund. It could be syndication a deal at a time, but they're pretty large. Where they have existing properties, sometimes hundreds of millions of them, that have the entirety of the equity wiped out, completely gone, all of it. And at that point, they have a decision to make. Do we sell and maybe realize, let's say, 20% of the money? That's something. I mean, but as soon as you do that as a GP, you're in the news. It's not so difficult to figure out that you bought the property at X, sold the property at Y at a massive loss, equity is wiped out. Like I'm saying that it's not rocket science. So this will be all over the Wall Street Journal, Real Deal, a bunch of other places. And at that point, you not necessarily stop your fundraising journey, but it's certainly impaired, right? It's much harder to fundraise at that point. Now, keep in mind, from the LP perspective, it's no brainer. Like, you should sell now to at least get me something back, right? From the GP's perspective, they're sitting there and they're like, by the way, there's ethics here, so I'm ignoring that for a second. Someone hopefully would be ethical and be like, well, I got to take my LP's interest before mine, but I don't see that all the time. So I'm talking about those cases. A GP is sitting there and they're like, hey, okay, so I have two options. I can either sell now and essentially end my business from a fundraising perspective. And a GP, by definition, runs on press and track record, all of which would immediately be impaired. Or I can like take this pref equity from a third party, and worst case scenario, the same thing happens. A little bit worse. In other words, I'm not going to be able to return 20%. I might not be able to return anything. But there's like a, let's say, 15% chance, usually lower, that my equity will make something out of this. That's how they sort of rationalize this, is that there's like this tiny percentage, probability of making more than that like sort of 20% that they can get today. But the reality is, in probability, every LP logically would pick to sell today rather than taking like a tiny probability of, let's say, 50%. And in the meantime, that same LP is committing to their next deal. Literally, like, I mean, this is like clockwork. Everything is fine. The worst is like, we're not doing any capital calls, but like, really that means is like, we're not doing any capital calls from you, but externally we're raising money on your deals, even though your equity is gone or deeply impaired. So there's like some cute language, as I like to call it, that is pretty deceptive.
That is a rough situation to be in for the LP. If you are talking about ways to avoid this, obviously looking at the interest, but the interests are always going to be misaligned somewhat, especially in terms of once you get into like not just the monetary interest of something as obvious as an extra fee, this is an acquisition fee, or, but when you're talking about like PR, like this is going to ruin my reputation if I reveal that there's something wrong. That's a pretty strong incentive to keep quiet. So then it's like, okay, you look at the track record, but track record can also be deceptive, especially you're looking at a period of low interest rates. So, you try to gauge someone's ethics, but you don't have that much time with them. What's the best strategy? What do you use? What are the strongest signals to avoid getting into that position?
Look, once you're in the position, I get a lot of inbound requests from existing LPs, and a lot of the requests are like, hey, we don't have a capital call yet, but I think this is headed in the wrong direction. Can you help? And it's like, well, sort of. In other words, I can sit there with you and think about strategies. The problem is, we're not the drivers. If you're a significant LP or have like a deep relationship with the GP, you might be able to influence them in a sense by pressure or by suggesting a new idea, but they still don't have to take it. I would say 9 times out of 10, the LP's greatest ideas can just be totally ignored. So I always like to tell people that up front, because I don't. It's one thing to sit there and brainstorm, but like, if the greatest idea ever doesn't get put into action, that's important to think about up front. On the front end, Ricky, like, there's no shortcut. Like, I mean, every investment is pretty complex, and whenever someone calls me and they say, hey, I don't have time, like, I just want to put 500 grand somewhere, where should I put it? I just say, like, I don't know, like, put it into the S&P, but like, you should not, in my opinion, be investing in the syndication, because like, you don't have time to understand what to ask. It requires time and effort, to thoroughly look at all the different things, and even then things can go wrong. Like, meaning there are GPs that truly thought about something and didn't take excessive risk, and something happens, like a fire breaks out, you forgot, to have insurance that's high enough, and like, things happen to the best GPs. And from the LP perspective, you can't minimize risk to zero. The only thing with zero risk is treasuries, and sometimes I wonder if that's zero risk itself. So it's a journey, Ricky. You know, like I teach my LP cohort and always tell people it's extremely easy to discount a deal based on one thing, and I think it's such a terrible idea because it just ignores the entire investment process. Someone who has, let's say, 5% pref. I don't know. Let's say 5% pref. And you're like, oh, this is terrible. Like, I don't want a 5% pref. And it's like, well, let's talk about the context. Like, if you actually went to the next slide, you would have seen it's a 5% pref, but it's a 90-10 split. Like that becomes a little bit more market, right? And just because 5% is the pref doesn't mean it's current either. Like sometimes if you're developing or adding value to a property, you're not getting paid current for a few years potentially. So like what's the difference between 5% accrued over the next few years versus 8% accrued over the next few years? You're not getting paid. So I would prefer, the 90-10 split any day of the week over like a 70-30 with an 8% even. You know what I mean? Assuming the property does well, right? So and it just goes on and on, right? And imagine you see something really heavy and unusual, like I don't know, 8% pref, and then you go to the next page and it's like 50-50 split, and you're like, ooh, I don't know about that. But then you go to the next page and they tell you that like the GP is investing 50% of the capital. It's like, oh, like that's impressive. Like that's the talk about commitment. You know, you don't typically see 50% of GP's capital in a deal. It's usually 5%, 10%, right? And it just keeps going. I'm just giving you a few examples, but like it's so important to sort of do reps in this world to understand how to compare deals to one another, how to understand like how one variable sort of impacts your overall decision. And I think people tend to want to take shortcuts, and sometimes they get lucky with them, and sometimes they get unlucky with them. So the way that I wrote a whole article, I saw someone like invested $5,000 into syndication, lost it, and then sued the GP. And I just said like I don't know why you would ever invest $5,000 into like a real estate syndication. In other words, just the diligence time to look at that deal and vet it properly will cost you more than what you could ever make. And if that's the case, meaning either you're doing the diligence or you're just kind of like in you only live once, like YOLO mode, right? So if you're doing diligence, then I would argue it's not worth it. If you're in YOLO mode, like YOLO into something that has like unlimited upside, not real estate.
Buy some crypto.
Yeah, whatever. Like I don't know. I bought some crypto recently for the first time, just for fun.
Riding the wave up.
Yeah, like, but whatever. I mean, even, stock market, I don't know, some like micro cap company,
Some Nvidia stock.
maybe invest in like some VC deal, and it's just like, listen, like I expect this thing to go to zero, but like if it crushes it, it's going to be awesome. Right. But like that needs to be $5,000 that you really don't care about. Like you essentially wrote it off until hopefully in 10 years you get some cool check.
In your LP course, how do you teach people to review deals? Do you give them a structured framework to look at this? You said it's important to do reps. I think you said you go over like 4 different memos in that course, 4 different investment deals.
Yeah.
At the end of that, do you also give them here's a checklist to go through in terms of, look at all of these pieces of information when you're going through the deck, look for these key terms?
Yeah, so I'll actually point people to a lot of my work on the Substack that I run, like LP lessons.substack.com. There's 2 articles in there in particular, like top 15 syndication mistakes, and I wrote a recent one on the 26 question to ask a GP. I think those 2 articles alone, I think they can like really impact the probability of you not getting screwed. And then what reappears like literally every single deal that we look at in the cohort is the 3 pillars, right? And we sort of walk through them in detail because every deal that I do is in different asset class, so it sort of helps people go from one like a multifamily property to an industrial property. Originally people are like, whoa, like I don't know anything about industrial. But then they realize after seeing the multifamily one that a lot of the lessons in terms of like how to view an LP investment will apply to any asset class, right? And I think that really helps. That helps people think about investments and get a little bit more comfortable with asking questions and not being scared. And I mean, it sounds funny, but a lot of people just are scared to ask questions.
No, I mean that definitely rings true. There was a point during undergrad where I decided that I was going to be shameless and asking questions, and I was like, like I didn't make a conscious decision. I was like, I'm going to be the stupidest person in the room, just in terms of asking questions, and I felt like that was enormously useful. Sort of catapulted me forward beyond where I would have been if I hadn't made that very conscious decision. Yeah, it's uncomfortable.
Totally, yeah.
How do you price services? You said $1,000 for a review. Is that like a fixed review fee, or do you charge hourly?
Yeah, so I started the business. I mean, I started it on Twitter, and the thing that I tweeted was like, "Why wouldn't people pay $1,000 for something like this?" And that tweet like kind of went viral, and semi-viral, I would call it. And it gave me a lot of strength to start the business. So I haven't moved from that number in terms of sort of like the basic review. And I think in 80% of cases, that review is enough for an LP to understand like either I was completely misunderstanding the risk on this deal or I was generally on. And if they're generally on, they can choose to do more. I can sort of like dig deeper if it's necessary. Or they're just like, look, wow, this is great. Like it was really helpful for me to, get independent thoughts on something. And I think I'll do it. You know what I mean? And I think both of those are good.
That's awesome. I also, my consulting career was born from an article that I wrote that went viral on Hacker News.
Oh, nice.
Viral posts are a great way find out that there's demand for something.
Nice. Yeah, I haven't gotten the hacker news yet, but like I do want to there's a lot of the tech world I just haven't explored. Like, I've thought about making a Reddit account, hacker news. I don't even know where to look. I'll pick your brain on that one day.
I mean, Hacker News is great because you can, post your own content. Reddit is a little bit harder nowadays than it used to be. And it used to be there were more subreddits that you could post your own stuff. Now, a lot of subreddits police pretty hardly, where, you gotta be hardcore committed to like posting other people's interesting content regularly. And then every once in a while you can put yours in, otherwise the moderators ban you. So, Hacker News, I would definitely say, is a superior distribution channel. Is that how you got your first clients? Was just from that Twitter? I
Yeah.
saw your LinkedIn, I think, says that you started a business in March 2022. Did you pivot into consulting? Like, were you? I think your business is something capital, so I presume you started either trying to raise money or investing your own money.
Yeah, I did. Yeah. I started on the investing side and interest rates happened and I decided to not buy anything at the time. And then actually got a job at a syndicator after that, which I've decided to sort of like not mention for several reasons. And then tried to do some cold calling, which was fun, like I just thought it was like a pretty fascinating venture. And then I just got onto this idea, like I think it was probably around August.
What was the cold calling for? Was that while you were at the syndicator?
That was after I left the syndication world. I decided to just try to cold call owners in Phoenix and see if I can buy a property.
Do you think you'll go back to that world? What is your ambition with your business now? Do you want to, grow it as a solo consulting firm? Do you want to hire a team and turn it into a boutique firm? Do you want to eventually get back into the investment side?
I mean, I do love investments. It's really hard to tell, to be honest. I could totally see this being a very big business just by doing consulting. Certainly could have a few dozen people working on all the deals. I mean, at this point, my list of subscribers is a little bit over 2,100. I'm 5 months in, and but the reality is I think I recently realized this. Like, I think there's literally millions of people in the U.S. alone. Like, forget about other countries that would appreciate something like this. I think, and like, look, if at some point I realize that I'm wrong, then I could certainly go on the investing side or do something else. But I think there's a lot of building to do. I feel like this is sort of like I haven't even scratched the surface of the beginning of this business, so to speak.
Are you comfortable saying like a range of how many customers you've had so far?
Um,
Like more than 50?
Probably around that range. Yeah, yeah, I think it's probably around 50. It's actually probably more than 50. My guess is probably like 75. Um, the interesting thing is like a lot of people reach out and they'll be like, yeah, I really need help. I don't really know what I'm doing. And then they say, yeah, sure. Like I charge $1,000. And they're like, oh, you charge? Like, I think I know what I'm doing. And it's like, it's, and you just learn from that over time. It's just something I've kind of gotten used to. Like a lot of the inbounds don't actually translate to paid work. But like you form the relationships over time, and I'm in this for the long haul. So like I think just because they felt comfortable on a given deal doesn't mean that they're not going to call me back a year from now.
Are they all finding you from Twitter, or are some of these coming from your existing network?
No, not much from the network. I mean, I haven't called on my network. I literally haven't done anything in terms of outbound sales. Like everything is coming inbound. I would say probably 80% Twitter, 20% LinkedIn. I just recently started posting on LinkedIn. In fact, I don't know if I've had a customer that did not come from LinkedIn or Twitter. Maybe one. I don't know. Like I can't think of one.
That's very impressive. 5 months in, 75-ish customers from just Twitter and LinkedIn. And I think you have roughly like 20,000 followers, a little bit over now, right?
On Twitter, yeah, yeah, and that was probably like about 18 months of work, consistent work, and in a funny way, I didn't know why I was doing it. In other words, I didn't have plans for this business at the time. I just knew that like having a presence will be helpful at some point, and I didn't know for what. And then I got this idea. I like literally sort of beta tested the idea on Twitter. I just posted about it, and I got a lot of really good feedback. Some people were like, "This is a terrible business. Don't do it." Some people were like, "Hey, I really like this. I think I wish I had existed and I would pay for it." And I was like, "Oh, interesting. Okay." And then I think I got like 50 DMs in a period of like 2 days. Maybe three of them ended up paying, you know, but I'm still very much off the grid. Like, I don't have a formal website yet. I'm basically like a LinkedIn and Twitter guy. um,
Substack is pretty good.
yeah, yeah, and Substack, yes. And
I heard on a different podcast that you did, this from like 6 months ago. You said that you had a spreadsheet that you track the number of Twitter followers every day, and you were trying to grow like 1% a day.
yeah, I still do. I still do. Yeah. Now it's three different things. I track Twitter, LinkedIn, and Substack as well.
Do you have a systematic strategy for growing on Twitter? It seems like you're pretty analytical. I know you have like a quadruple major in like math, finance, accounting, and econ. So are you approaching this systematically? Like, I'm gonna post on Twitter this number of times a week and reply to this many people, post on these topics.
Really not. I mean, so my systematic approach basically starts and ends with two articles per week on Twitter. Like, sorry, on Substack. I think that's the only rule. Some days on Twitter I just totally miss because the holidays or I'm busy. Some days I'll post like 4 times a week, 4 times a day. Sometimes it'll be like memes or me rock climbing or something. I haven't really cracked the code. To be honest, on Twitter or LinkedIn. Like I've just done it consistently for a long time, and I've had some posts that went viral, but like I still to this day I don't think I'm great at it. Like I do it consistently, and the 1% per day thing is like it's so powerful. I don't know how to describe it. Like I think seeing that come alive at some point. I think a few weeks ago I came across one of my journals from like a year ago, and my goal for that day, like there was like a list of goals in the personal journal, and one of my goals was to get to like 400 followers on Twitter. And I just opened it. I was like, man, that's so crazy. Like it's just crazy what can happen over a long period of time if you just do it every day. And so at some point I had 400, and my next day was 404, and then it was 408, and so on and so forth. And some days you'll like surpass it. Some days I sort of even have a tracker of like my life to date performance. In other words, like
Hey, what's your compounded average annual or daily growth?
Yeah, no, it's just it's fun, and to be honest, like now I'm like growing so slowly on Twitter and LinkedIn. It's like not even close to 1%. Like if I do 1/4% per day, that's like a good day. So it's actually like the 1% thing for LinkedIn and Twitter has gotten pretty frustrating. But I will say that I mean, I do it more for Substack now because the numbers are still sort of
Small enough.
1% friendly. But like it becomes really hard at some point, and I haven't cracked the code on like how to grow consistently, but it gives me a lot of strength to kind of like look back. Even like I think on Substack I'm like at 2100 now, give or take. Someone sent me an image that I sent them like from a few weeks ago when it was like 1600, and I was like, wow, that's crazy. Like 500 people, over a few weeks, and but day to day, like I see like 10 people pop in, sometimes no one pop in, sometimes 50 people pop in, and it's like it's very turbulent sort of like day to day. And then when you zoom out, it's like it just gives me a lot of strength. It's just me running this, and as I found a lot of strength in that sort of daily routine of seeing how things are progressing, even if the daily increase is small.
Do you track any KPIs other than just raw follower count? Because I feel like something you do pretty well is like your Twitter following seems to have moderately high engagement. I mean, I don't have any metrics, just and obviously this sort of sampling bias of the things that I see of yours, but it seems like you generally have pretty good engagement and that your audience is pretty well aligned. You don't make too unrelated of content, so you don't end up with people who are like, "Oh, I joined, I followed this guy because he posted about this one random thing, and I like that one random thing, and then oh, now I don't know what he's talking about over here, so I just sort of like silently stop following, but I'm still counted as a follower."
Yeah. So to answer your question is like, yeah, I don't do any KPIs, but I will tell you that I don't know if this is cope. I don't know if it's like a coping mechanism, but I think I've realized that the quality of the followers is a lot more important than the quantity. In other
Exactly.
words, like I could push out a bunch of content that would probably generate a lot of followers, but I think I would also like lose not necessarily credibility, but appreciation from people, and I don't know if I want to spend time on those topics. There's a topic that breaks on Twitter every single day, and like if you write about that topic in a good way, you'll probably get 100 followers that day. So like you could basically do that every day, but it's just like I just have zero interest in that. You know,
Yeah.
I'm not like a very opinionated person when it comes to politics or pop culture.
Yeah, I do think a lot of people don't appreciate that either because like I've experimented with that a little bit, trying to is there a topic that is relevant that I can somehow connect to what I'm doing, and I have not really found that to be very successful. I found it to be more successful on video platforms, but less so on Twitter. I also haven't treated Twitter consistently enough. I've been very sporadic on Twitter, so I have a lot more experimenting to do there.
Right, and I mean, I appreciate it because I think I learn a lot more from Twitter than any other platforms personally. And some days I really hate the anonymous parts of Twitter, and some days I really like it. Like at least a few times a week, I'll get some anonymous account that sends me information about what's happening with some GP. You know, and I have no idea. I have no way to figure out like who this person is. But that is, I think, why they're comfortable sending it to me. So there's like that component, and just in terms of feedback, I think it's always good to sort of take criticism on your business. Sometimes it goes too far, and as an entrepreneur, I think you can probably appreciate like sometimes I have a hard time like differentiating between opinions with like good intent or just people that are in a bad mood.
Yeah. I also heard on a different podcast you said you own a couple residential rentals yourself.
Yeah.
Is that all your investment right now? Just the couple residential, or do you have any commercial real estate investments going on?
For now, that's it. I've thought about selling. I'm not sure. Like, I'm trying to figure out what would be best for the family. I guess to be candid, like I think at my level of net worth, like I don't think syndications make sense. Which is something I talk about pretty openly. You need to have like a certain level of net worth to play in that game because like there's like a liquidity and you can lose money. It takes time, right?
Yeah, a 5% and return on investment for me is not very interesting. I'd rather deploy it into my own business, or
Right.
I have a couple rental properties also that I've just not syndicated deals, just me and a friend of mine just in together, and I selected those have a much higher rate of return. What was your biggest annoyance when you bought these residential real estate properties?
Like I just hate dealing with them. I hate with a passion dealing with them. And I'm too cheap to hire a property manager.
Same.
And my wife always laughs at me like I can barely like change a light bulb. I'm just like not that type of person. So like sometimes I'll go and like try to figure out how to like fix the dishwasher or whatever. And I really hate those nights. It's always nights. And then every single time I like, oh, okay, this is for sure broken. And then I end up calling someone and they fix it in like 20 minutes and charge me $150. That's probably the biggest thing. But yeah, yeah, it's like it's not so passive always.
Yeah, definitely.
Right, it
What
sounds like
was your
it's
biggest
annoying.
annoyance when buying the property? Like when dealing with realtors, what was your biggest annoyance?
Um,
Because you spent, I think, for reference, people who don't know, right? You spent a lot of time when you were working at the REIT, basically reaching out to single tenant occupants of commercial buildings, trying to do lease buyback strategy. So that's sort of like searching for off market commercial properties. When you go to buying on market residential properties through a realtor, did you find it particularly annoying, or was there anything about that experience that bugged you?
I think the hardest thing is finding realtors that are good. I think the ones that are actually good are worth every penny. The ones that are not so good are pretty difficult to deal with, because I mean it's a sales process and you sort of like feel bad because like you use them to like see a property and therefore you should use them. It's just
Yeah, there's some psychology that definitely goes into play there, some reciprocity.
yeah, yeah, and it's like you as a new buyer, like you sort of have no way of knowing if someone is good or bad, right? Like there's just no process to vet a broker or realtor, sorry, I should say. So that process was pretty difficult for me because I didn't know much about what I was doing, and sometimes I would be asking questions that like the realtor didn't know the answers to, and I would have expected them to look at that before we even engaged.
Yeah.
But look, I mean, it all ended up working out all right.
Yeah, I remember when I flew around to several different cities and different states when I was looking for markets that I wanted to invest in, and so I sort of learned a little bit each time in terms of interacting with the realtors. This was when I was buying my first property, and in the market that I ended up buying in, I used a realtor that the brokerage was an investor focused brokerage, and the numbers that they gave me for annual growth were arithmetic average, not compounded average. The contract had mistakes. I bought several properties through them, and like each time there would usually be at least like one typo. And I'm like, this is mostly a template contract. And this is like the highest rated investor focused brokerage in this city.
Yeah,
And each time it's like it's a template contract. There's only so many fields you have to fill out, and you're making a typo. And then in one of the properties, there was an issue where the seller, just listing agent, put in something, something like appliances that weren't end up, they said they were included, and it turns out they were owned by the tenant. And then I was like, hey, what's this? You got to pay us. And our realtor pressured us to not do it. And she's like, it's just a mistake. I'm like, yeah, but it's in the contract. We paid it's in the contract. Like, why are you not advocating? So I'm like, no, like I'm happy to go to small claims court here. Like, please advocate on our behalf.
Yeah.
And
Yeah,
I
and
was like,
again,
that's
it's
just
sort of
ridiculous. Like,
to your point. Like I think there at some point becomes a conflict of interest.
yeah,
It's a classic like principal agent problem.
yeah, exactly.
For example, like the broker, your broker is really just incentivized to sell it or buy it, right? They're not necessarily incentivized to get you that extra dollar, whether it's on the way up or the way down, because it doesn't impact their commission. I mean, it impacts it by dollars. You know what I mean? So when you want to negotiate, it's more like, oh, I don't know, like, should we negotiate? So it's weird. You sort of feel like you're negotiating with the person that should be negotiating for you.
And it's almost like the selling agent and the buying agent, actually have loyalties to the opposite parties, because the marginal commission that you get from moving the price up or down a little bit is just not that high. So the broker is, basically like just trying to close the deal. So the seller's agent wants to get the seller to go down as much as possible, and the buyer's agent wants the buyer to come up as much as possible. Their incentives are basically reversed.
Right.
Thanks so much for coming on, man. This has been awesome. If people want to reach out to you, just Google your incredibly unique name.